So for 2012, I think we expect a lot more of the same of what we saw in 2011, a fairly steady pace, but nothing that's going to really blow the doors off of the market in M&A. We expect Canada to continue to be a strong player in the global M&A market. And as we look at where we may see some of the activity, I think certainly in the areas, again, back to higher yield returns or the ability to get better yields than what can be obtained through alternative investments. I expect we'll continue to see quality assets being very attractive. Real estate in particular, we expect to see infrastructure as being an important area where we'll see some deal activity and continued involvement with pension funds being acquisitive, looking for alternative direct investments as opposed to maybe playing as much in the private or the public equity markets. Some of the other trends that we might also see going into the marketplace, when we look at maybe sort of mid-cap, small-cap public companies, we expect we may see more going private transactions. Again, there's going to be a desire for quality businesses and assets in the marketplace. So those will be attractive. I think we're going to see pension funds diversifying away from the volatility of the public markets, so more emphasis on doing direct investing. I think the governments are going to be looking hard at where there are opportunities to raise money and improve their balance sheets. So that's going to mean that there's going to be divestitures of government assets. And the divestitures of the government assets should lead to an appetite or an interest or an increase in the overall level of deal activity in the infrastructure space. I think the other area that's going to be really interesting is going to be in the area of emerging markets. And I think there's probably been a bit of a tentative view on emerging markets. I think everybody conceptually gets it, but there's a lot of concern about how do you go about dealing with emerging markets. And I think we're going to start to see more of an attitude of, you know what, they're very important, they're here to stay, and we just really need to get on with it. So we expect to see more companies looking at emerging markets as a place to invest, really the growth engine of the future, especially when you look at it in the context of the rather tepid growth that we're going to see both in Canada and the rest of North America, and even in Europe with the struggles that it's having. I think the biggest thing that's going to potentially put a damper on that, however, is how companies go about approaching the emerging markets. We've just recently done a study analyzing over 200 different transactions that have taken place in emerging markets with a lot of excellent lessons learned. And certainly one of the things that we're seeing is that up to 50% of deals that enter into the diligence phase actually fail to result in the consummation of a deal. So that can cause companies to really step back, basically get a little bit gun shy because it has a negative impact on the perception of investors in the business if they spend a lot of time going after a deal and then aren't successful in getting a deal. And we're also seeing when deals are closed, but there's a problem with the deal, that there can be up to 50% of the value being lost in the deal. So the post-deal success can be challenged as well. So I think it's going to be very important for companies that are looking at emerging markets deals to be very careful in how they go at it and to learn the lessons from those who have been there before them if they're really going to be successful in doing those deals.